Hello, everyone. At Communitech, we're working hard to bring you business as virtual as much as possible while we're supporting our members the best we can. I hope everyone's doing well today. Good afternoon. Thank you guys for joining us in our Ask Me Anything session today. My name is Gamal. I'm one of the Communitech startup advisors. I'm very excited today to have Charles Plant with us for our session, So You Want to Be a Unicorn. This session is a special session. It's actually a small taste/teaser of future sessions that we have developed alongside Charles that will be running in the next few months. These sessions are to help entrepreneurs enhance their knowledge on becoming a unicorn business, and we'll be diving into deeper subsegments of Charles's research. Before I turn it over to Charles, I have a few housekeeping items that I'd like to share. Number one, just a reminder that this session is being recorded, so it can be shared at a later date as a resource for other companies. You can find all of our AMA recordings at communitech.ca. You may want to minimize your speaker view on the right-hand side of your screen in order to view the full presentation. I ask that you please keep your microphone on mute during this session. Please use the chat functionality to ask any questions that you have. We are welcoming questions throughout the discussion today, so don't feel like you need to hold your questions until the end. If you're interested in following up after the sessions or are interested in joining the following sessions about becoming a unicorn business and unicorn math, you can send me an email. I'll be leaving my email in the chat. It's gamal.assad@communitech.ca, and I will be able to connect you and add you to the future sessions, as well as connect you with Charles if that is necessary. Before we hand it over, I just wanted to remind everyone that please check out our Communitech website, Your Week in Tech, as well as our newsletter for upcoming AMA sessions. Our AMA sessions happen every Tuesday at 2 p.m. The next one discusses raising investment in Waterloo and Silicon Valley. And with that, I'd like to turn it over to Charles to introduce himself and start today's session. Thank you.
Thanks, Gamal. It's fun to be here, and I love seeing all these names. It's sad that I can't see faces, and because I get lots of clues on how people are understanding from faces. But in any case, this is a fun subject for me because I spent over 20 years working on it effectively. The name Unicorn Math comes from Ian McDonald. I have to give him credit from Communitech because I was calling it, in search of world-class companies or something like that. And he said, oh, something like Unicorn Math would seem to work. And the reason I've been doing it for 20 years is that I spent 15 years as the founder and CEO of a telecom software company. I know people like Nick, you've heard this story before, so you'll have to excuse me. But in developing that company, we did well. We grew internationally in US, Canada, and England. We were profitable and growing at 30% a year for the last 5 years, but we just created a mid-sized company. We didn't create a large entity. There weren't unicorns at the time. We didn't create one. So I was always wondering what it took to create a unicorn. What's it take to actually create a world-class company? And so I started poking around in research. I tried working for different firms. I've been the CFO of a whole bunch of them. I've co-founded several other companies in the meanwhile, and I've worked in investment banking. I've worked in venture capital, all the while trying to figure out what's it take to create these mythical beasts, the things that Canada isn't particularly good at creating. And about 6 years ago, I started to do research. And the research has taught me more than any amount of work has ever taught me, because I've been able to look at thousands of companies and say, what does it take to create a world-class company? And I've been able to apply what I've learned in working in about 20 companies to the study of thousands of companies. And so this is what you get today, a distilled down version of what I'm calling unicorn math, or what an algorithm is for really rapid growth. So I'm just going to start with the screen here, and give me half a second. So fundamental of unicorn math is that companies are eventually judged on their economics. They're really judged on their ability to turn ideas and cash into growth. And you might be surprised to learn it really doesn't matter what industry you're in. There might be different tweaks for every industry, but fundamentally the idea is the same, is that investors want to put money in and get money out, And it really doesn't it doesn't matter to them what they're investing in. If they see something that's going to increase their money, they're going to invest in that. So you're judged on the economics, your pure economics in the end result. So understanding that economics of growth is really what works to accelerate your growth. And it can do this another thing, it can reduce your capital requirements. So it can increase the ROI of any firm seeking to innovate, and it sort of works as a framework for achieving rapid growth in firms of all types. And I'm going to bring out 5 elements of a framework today, because that's about the main tenets behind unicorn math. Each of those will be done in one session that Gamal mentioned earlier that we'll be having over the next several months. So if you want to dive down into each one of these, it's possible through these other sessions. So we're talking here about unicorns, and there are a lot of people who say, well, unicorns isn't something to aspire to, but I see it as a stage, and it's a great thing to use in marketing. It's a stage on the way to becoming a world-class company. And fundamentally, if you're going to go public in the United States, you're probably going to be a unicorn first. If you're going public in Canada, you might not be a unicorn first, and that there are a number of Canadian firms that have gone public in Canada only and haven't become unicorns. But we're talking about the massive data and the massive examples that you can get are US-based unicorns. So the whole concept of unicorns was only created about 7 years ago in 2013. At the time that the idea of unicorn was created, a company with $1 billion value, there were only 35 unicorns in existence. Back when I started studying this issue in the early 2000s, you could look at companies that are going public at 10, 15, $20 million. You're able to see what they were doing in terms of revenue and expenditures when they actually had zero revenue quite often. I did an early study about 18 years ago about 65 companies, and they were phenomenally a lot smaller than companies are today. But because of the nature of private capital and venture capital, a lot of money has come into the venture capital community, and a lot of that goes to put growth into these firms that become unicorns, because the venture capitalists earn a return for a longer period and a greater return by keeping the returns to themselves. Right now, there are about 465 unicorns. I'm probably wrong by 10 or 20 because it changes so often now. The number is increasing so much. There's so many countries in the world that are having unicorn booms that it's really quite amazing that the whole world is catching on, and it's a whole new style of investing and growth. The 3 top US unicorns right now, and I had to check because it changes so often these days, are Stripe, SpaceX, and Airbnb. Now, Airbnb, I haven't looked at their S1 yet. They are going public right now. So it'll be interesting to see what I've been looking at behind the scenes for a number of years to see their actual numbers, to figure out how they're doing. But these are companies that you see regularly, maybe not Stripe, but you certainly see SpaceX all the time. It was in the news the other day. Airbnb is in the news all the time. They're only founded, Stripe in 2009, Airbnb 2008. They've gone to an 18 or $36 billion valuation in 10 or 11 or 12 years. That's really phenomenal when you think of it. But that's even dwarfed by companies like Uber, which has $14 billion in revenue after 10 years. You sort of look at this and say, okay, why is this happening? And the fundamental reason it's happening is that the market values growth more than anything else that they could potentially value. Growth is the number one thing in the market nowadays. And this graph reflects it. It looks at a number of companies and their growth rate on the bottom line and their revenue multiple on the side. And the revenue multiple is their valuation divided by the revenue. So for instance, if you want to look at the top right dot there, with a revenue multiple of 20 and a growth of 90%, that's actually Shopify. When I did this a few years ago, Shopify was the fastest growing firm in the US. Okta was another one that was growing almost as fast. And you can see the revenue multiple that Shopify got because of its phenomenal growth. You can even look in the last 7 or 8 years at the firms that have done extremely well, the firms that have gone out there, Twitter, which was growing at 300, 400% when it went public. Others, they're actually achieving multiples of growth after they go public of 77 times, or revenue multiples of 77 times. The market does not value profits. They don't care whether you're making money or not, because they realize that if you're making money, you're going to be slowing your growth down. And a company that's growing at 50 to 100% a year is worth a lot more to the market than a company that's profitable at 10% profit rate. So fundamentally now you need to grow, and that is the most important thing about creating a unicorn and creating a successful company that goes public on a stock exchange. Now, getting to this issue of a billion-dollar valuation, in the magical unicorn number, the average company that has a billion-dollar valuation has raised about $212 million worth of capital, and they're doing about $125 million worth of revenue. So when you're thinking of these numbers, it's somewhere in the neighborhood of about 4 to 5 times capital for valuation and about 8 times revenue for valuation. This is the typical unicorn. And when you look at companies going public, that's about the rate at which they're going public. They're doing a bit more than 125 million, depending on when you're looking, but their valuation is about 8 times revenue because they have these phenomenal growth rates. So this is what gets to this issue of unicorn math. And I wonder if there's a way so you can't see the last column of this, but I'll have to tell you what it says. The fundamentals I'll summarize of unicorn math before we start going. First of all, that you need a large market. And this is about a $15 billion market growing to about 25 billion in 10 years to become a unicorn, because the large market actually increases your growth rate. Second thing you need is a really high competitive differentiation, because the competitive differentiation is going to lower your cost of customer acquisition. And I typically talk with companies about a 50% differential between customers in some measured basis, and we'll get into that. The third item is your product market fit, and the product market fit increases your long-term lifetime value for a customer. So what we're doing here is your competitive differentiation lowers your cost of customer acquisition, your product market fit increases lifetime value. What you're looking for is a net promoter score of about 30 or 40, or another measure, a very dissatisfied measurement. We'll get into that. The fourth element is marketing efficiency, and marketing efficiency reduces required capital. So you want marketing to be about less than 33% of the following year's revenue. Now, all of these come together in a certain way, in that if you can put these together and get high growth, then your high growth is going to attract capital. And the average per annum of these unicorns is about 75% growth over their history. And your sufficient capital fuels high growth, about $2 of capital per dollar of revenue. So high growth attracts capital, and capital creates high growth, getting into a blissful situation. And in the far right, you'll unfortunately not be able to see it, but it is a thing that says unicorn valuation, and the valuation is equal to about 4.7 times your $125 million worth of revenue to become a unicorn. So that's the fundamentals of unicorn math briefly. Now, in terms of the development of a company, you can actually look at stages of development and line up what you have to do in developing your company in accordance with those stages. And so unicorn math follows directly along these stages. And these are stages that were developed by Startup Genome, the Marmer stages as they're called. And the first stage is ideation. And your objective during the ideation stage of your business is to find a large market. We're talking about metrics of about 15 billion. There's no revenue growth required at that point in time. You'd actually pre-revenue, and the money coming in is from founders. Your next stage is a discovery stage. You're going to want to find strong competitive differentiation. That's 50% multiple. Revenue still is not applicable because you can be doing this in their development stage. Typically, your funding is from accelerators at this stage while you're under development. Third stage is validation. The idea is to get excellent product market fit, some ratio of net promoter score above 30, et cetera. Here, you're going to look for revenue growth for the first time of 10 to 20% a month. And your funding for this is seed stage funding. Your efficiency stage, you're wanting to get market efficiency of about greater or less than 33%, or 3 to 1, 100 to 200% growth a year as you're in this marketing efficiency stage. And That's Series A capital, the results from this. And finally, when you're scaling, and some people think scaling is happening at the validation efficiency stage, it really isn't. You have to wait to scale. You have to prove out all of these other things before you should start to scale. Otherwise, what's going to happen is you're going to blow up. You're going to waste too much money on scaling. And so finally, when you get around to a Series B round, you're getting the type of capital you need, about $2 of capital for every dollar of revenue. You should, from there on, be growing until you go public at a rate of about 60 to 100% a year. Those are minimums for growth. And this is B, C, D, etc. rounds. So the first thing you really need in this is the first element that we're going to go back to is this a large market. And as I said before, a large market increases the potential growth rate of a firm, which increases the availability of capital. The bigger your market is, the faster you can grow. And this is something that I've spent a lot of time with a number of companies in understanding what the market size is. And there's a lot of confusion amongst companies. And for some reason, it can take months and months and months to actually figure out what your market size is. There is no one report that can tell you what it is. There is no one calculation that can tell you what it is. A lot of people end up confusing what is effectively potential addressable market from your total addressable market. And the total addressable market is the current spending, the amount that is being currently spent on equivalent products, on the things that you're going to disrupt, on the products that you're going to displace, so that you can get your product into the marketplace. So it's equivalent products that you're replacing with your solution, and it's actual spending, not numbers of people by multiplied by how much they can spend. That is the potentially addressable market. So in terms of markets, it's really difficult sometimes to figure out what that the total addressable market is. In one case we were looking at recently, it appeared from a number of reports, even from Frost and Sullivan, that market sizes were in the billions a year, but they'd misestimated the number of people. In this case, it was a medical problem that people were trying to deal with, an assistive device that was developed for it. People were misestimating the number of people who were afflicted with this problem. And as a result, they anticipated higher market sizes. And we took a number of months to finally be able to get a measurement of the total addressable market that was in line with what we thought was actually being spent out there in the marketplace. Potential addressable market is the number of people that might be like that, who might spend someday, but you can't eat potential addressable market. You can only eat by taking market share away from someone else, taking spending off of something onto something else. And that is that critical element about what is a market that people need to understand. So I want to look at 3 examples of companies and 10 years from startup, because I think this really gets down to one thing that I discovered that was a real aha moment for me in June this year. And I was looking at all of the public companies all the companies that have gone public in the software and medical device space in the last 8 years or so in North America. And included in that are Uber, Dropbox, and a company called Exactly. I actually don't even know what Exactly does. You all know what Uber does. You probably all know what Dropbox does. And so the question is, Uber got to $14 billion in 10 years. Dropbox got to $1.1 billion in revenue in 10 years. Exactly got to 61 million. So what is it about these firms? Why was one able to get to 14 billion and one 1 billion? Was this a choice? Did Dropbox choose not to get to 14 billion? Did Uber make a choice to get to 14 billion? Exactly didn't choose to do either. What I discovered really interestingly was this was not the case. That in actual fact, the rate of growth and the size that people got depended upon the size of their total addressable market. And I went in and looked at all of the prospectuses for these companies, and I measured what they said their total addressable market was and compared it to the revenue they got. And I was absolutely amazed in that there's a really high degree of correlation between the size of the market you've got and the percent of that market you can get. So when you look at Uber, they only got to under 0.5% of the total addressable market that they were looking at. Dropbox only got to 2.21%. That was amongst the highest of the firms in this study, being able to achieve 2.21% of their total addressable market. Exactly got to close to the average for firms, which was about just under 1% of their total addressable market. Each of them is addressing a fundamentally different market. Uber at $2.5 trillion, in actual fact, now measuring at more than 5 trillion. Dropbox at more than 50 billion, exactly only at 7 billion. So what's happening here is that, the rate at which markets take up new technology is fundamentally driven by the behavior of the people in the market. And if you've ever looked at crossing the chasm, you've got to think of applying crossing the chasm on different market sizes. So you look at a market that's got $5 trillion of market potential, and the place you're going to get to is about the same place on the curve, but it's going to be much higher up in dollar value. And that's why some firms are able to get to revenue of 14 billion, others only 1 billion. And when you look at it, there are fundamentally two different market types. And unfortunately, these slides, can you move your, you can move the pictures off to the left-hand side if you haven't already done that. I was stupid and didn't do it. What I found in doing the study and studying these markets is that you've got three types of markets: consumer, corporate, and small, medium-sized business. And you can lay on that horizontal markets or vertical markets. So a horizontal market is somebody who's serving absolutely everyone. A vertical market is serving one type of market. For instance, in corporate, if you're serving all corporations like Salesforce, you're in a horizontal application. If you're serving just real estate agents in a CRM solution, you're serving just a vertical market. So when you look at all of the companies that were in this study and the markets they were serving, it was really interesting because the average horizontal market is much, much larger than the average vertical market. And that makes sense. If you're targeting a vertical solution, your market is going to be much smaller than if you're targeting a horizontal solution. Also, what I've found is that the consumer markets are much, much bigger than the corporate markets. On average, almost 10 times the size of the corporate markets. And when you look at the companies that are really successful in the marketplace, the Amazon, Google, Microsoft, Netflix, all of those companies are huge because they're serving consumer markets, and they're also serving horizontal markets. So your ability to grow rapidly is much, much greater in consumer horizontal markets than it is, let's say, in vertical, small, medium-sized business markets. When it comes down to it, the next best markets, although there's statistical anomalies in here in the SMB one because of Shopify, but for the most part, your best markets are consumer, then corporate, then small and medium-sized business, and your better markets are horizontal than vertical. Where that is really interesting is, and I'm going to diverge here into the issue of Canada and how we create companies, because Canadians are often discouraged from going into consumer businesses, and they're often discouraged from going into horizontal businesses. They are advised, and I've been part of discussions, I've heard people advised to go to vertical markets instead of horizontal ones. I've heard people being advised to go to corporate markets instead of consumer ones. We don't fundamentally understand the consumer markets, and we don't understand horizontal ones. And as a result, we're actually limiting our potential as a country and not creating unicorns because we're focusing on markets where the market size is too small to actually go on to create those unicorns. So the first of the fundamentals in unicorn math is your objective should be to be in horizontal, consumer, and corporate markets. Horizontal, number one, consumer better, and then corporate. In terms of the size of those markets, if you want to create a unicorn, and if you want to go public, and frankly, if you want to get venture capital, because venture capital only works if you end up really going public, is you should be in a market that's about 15 billion now and rising to about 20 billion in 10 years. You want to be targeting a market that you know where your TAM is about 20 billion in 10 years, because if you're successful, you'll get just under 1% of your TAM, and you'll get to a size that's enough to make you go public. You have the growth rates. So are there questions about that first element in unicorn math? And I think if you can put them in chat, Gamal will read them out. See what we got.
All right, we have a few questions coming up. First question from Alex Todd. For TAM, what if it's an emerging market? For example, Uber.
Uber is not an emerging market. They were attacking taxis, rental car companies, buses, streetcars, subways. That's a huge market.
Second question, I'm just going to read it straight up. I'm curious on your thoughts on a startup's ability to communicate its grasps of the economics of their business and whether that ability could lead to a lower cost of acquiring capital. Also, isn't the market starting to shift towards rewarding margins instead of growth, i.e. WeWork and Uber?
No, the market is not shifting. What you had in the WeWork case is very, very low gross margins. They were just improperly valued. In fact, before their ultimate valuation, I wrote a blog on what the valuation should be. You can find it on narwhalproject.org, and it'll explain the problem of valuing valuing a company that does not have the same economic fundamentals as the software industry using software industry metrics. They blew it in their valuations, was all. I want to go back to another question because in emerging markets, Apple started an emerging market, but even when Apple started way back in 1977, there was a market of $90 million a year for personal computers. And the key wasn't the $90 million a year, it was the fact it was growing at 100% a year. So you take that $90 million a year, put it 100% a year for 10 years, and you're going to get a $20 billion market or whatever the number is.
We have another question from C. Wilson. How would you differentiate your model in any way for medtech/devices versus other technology plays?
So I've done a lot of work in devices in medtech, and what you actually have is, and we'll get into this more at the end. The fundamentals still apply, but for every market, the numbers might be slightly different. For instance, medtech companies typically go public in three stages, either below 5 million, between 10 and 50 million, and above 100 million. In all of those cases, their total addressable market is usually in the under the $10 billion size. In fact, it might average about 2.5 billion. That's because the nature of the development of those devices means there's going to be less competition. So you're able to achieve more of the market than you would in software. Fundamentally, the same principles exist. The numbers might be different, and we'll get to the end of how you can create your own numbers if you're in a particularly different market.
We have another question from Alex Todd. Going back to the Uber thing, he says, Uber was a bad example for emerging market. A better example would be technology for improving and measuring impact in support of the United Nations 2030 SDGs. How would you measure that, Tam?
Well, that's a good question. When you start a business, you're either trying to disrupt an existing business or create one entirely. Unfortunately, where people try and create businesses entirely, it doesn't have a big TAM because you're not replacing any spending. And it's hard to get people to spend money when you're not telling them what they shouldn't spend money on. The reason, if you want to get somebody to spend money, you have to stop them from spending on something else. So if you are competing against somebody and disrupting the market, you can get them to move their spending from item A to your item Z, and they really haven't gone out of pocket. But if you're trying to get them to spend money on something they've never spent money on before, it's really hard and it takes a really long time, and it doesn't make the best unicorn.
We have another question from Adrian. Is it feasible to retain up to 50% ownership when trying to raise capital to create a unicorn?
Let's go on to that at the very end.
Okay.
I would say no, it's not feasible to maintain 50% ownership. You want to create a unicorn, you've got to raise $250 million or something like that, and you're not going to have 50% of your company after that. But if you have 20% of your company, you're going to be worth 200 million.
And then I actually just have a quick question. In Shopify's case, I just want to clarify, you classified Shopify, would you say it's a vertical SMB? Is that how you would classify it?
Yeah, well, that's difficult because the end user is a consumer. So it has elements of consumer and it also has elements of SMB because the SMB is paying to reach the consumer.
So it's a little bit of a hybrid.
Yeah, I'd have to go back and look at that and see how I classify that. I have a debate with myself.
I think that's the questions okay. I think we have another, maybe we'll take this one as a last question. Thoughts on starting with corporate or SMB and moving to consumer, for example, Dropbox?
Well, interestingly enough, I'm not sure that Dropbox did that because Box started, and Box is a good comparison to Dropbox. They started in the corporate space, and you can compare how well Box did starting 2 years earlier than Dropbox. Box is nowhere compared to Dropbox. I haven't seen the successes coming mostly from companies that started in corporate and moved to consumer. The needs are so substantially different that if you have something that the consumers want to buy, you're better off starting in a consumer market right away. I know that's not, a risk-free approach, and people feel that that's, it's less risky to start in the corporate world. I don't get that necessarily. It's just a different type of risk that you're taking on to doing it. So I wouldn't advise anybody to start in corporate to move to consumer. If you've got a consumer opportunity, start in consumer and do it properly.
Charles, do we have time for one more?
Sure.
So we'll leave this one as the last one from Mike Evans. What growth rate do VCs want?
Well, that's a good question. I know what works, and it's different at each stage. But fundamentally, you've got to think of growing at an average of 75% a year for 10 years. In the beginning years, you might double, you might even triple 1 or 2 years. RIM, for instance, only doubled 1 year or tripled. I can't remember which it was. The rest of the time, they just grew at 100% a year. It's really difficult when you're a large company to grow at more than 100% a year because the number of people you have to acquire in order to do that just doesn't work. It's just too complex. And so the scalable models like Uber are completely different. But if you can consistently grow in the beginning years, let's say up to 5 million, you might be doubling or tripling every now and then. But after that, if you can grow at 75% a year, 100% a year, you're going to do really, really well. And that's going to get really, really good returns for a venture capitalist.
Okay, I think we can move on to the next section. We'll ask these questions after.
Great. Okay. So the next section is competitive differentiation. And this is one that people seem to get more often than not. The greater the differentiation, the easier it is to raise capital and the lower your cost of customer acquisition. So when you're looking at customer competitive differentiation, the issue is different how. And a lot of people make up nice grids and graphs and things to show 1 or 2 dimensions of competitive differentiation. But what they really need to do is understand how they are different from a client's perspective. What is it that the client sees that makes you different? Understanding that you have to disrupt somebody else's business by getting people to stop spending on thing A to spend on your thing. You have to be different enough from that client's perspective to get them to change their spending habits. So the good example of this is Salesforce. And I remember when Salesforce came into the market, so different from the existing players in the marketplace. They entered a market in which the standard was an on-premise based solution that would take a long time to get in place, take $100,000 worth of capital, a lot of training, a lot of change, etc. And they offered a pared down product for a certain segment of the marketplace. And they got into the marketplace with something that was so totally different that they were able to rocket from a position of nothing to what is now about 19% of the market. What is interesting is, Salesforce is in a market that's about $46 billion, and they've managed to get about 19% of the market it's taken them from founding in the late 1990s till now to get to 19% of the market. So it goes back to that idea of market size being important. It takes a long time to overtake a market. And you can see from 2009 to 2016 how they tripled almost in their market share. That is with the most radically different product in the market. The first of the software as a service, beating out everybody else, beating out Microsoft, Oracle, and SAP over time because of that degree of differentiation, because they were so disruptive. Now, you also notice that they actually went into the market that was spending a lot of money already, so they were in a large market size. So I wanted to look at what it was and how companies were competing. And I went back into these prospectuses again, and I looked at 50 companies. And this is critical because I see a lot of companies that I meet and they say, well, one thing, one of our biggest claims to fame is we're going to reduce the costs. And that is actually a very poor basis of competition. When I looked at 50 companies, I actually measured each of their bases of competition. On average, they had about 10 points of differentiation. And those 10 points were divided into 4 different types. Some points of differentiation were the company and its reputation and things like that. A lot of those points of differentiation were based on quality, some aspect of performance, etc. A few were based on speed, and a few were based on cost. But fundamentally, companies are basing their ability to compete on quality and multiple dimensions of quality. And why this is important is that if they only go after one dimension of quality, it's easy to trade off one dimension of quality against others. So if you actually compete on multiple dimensions of quality at the same time, you're able to make a strategic difference from your competition in the same way that Salesforce did. They competed based on cost. They competed based on the speed of acquisition, the speed of learning, the quality of the platform in the end result. But you're able to get the competition and make a significant difference if you're competing based on quality. What I try to do now is I try to get people to measure the buyer's journey in some way. And so here developing is just an example. You don't need to look at the specifics of the example, but each of these lines represents one element of a buyer's journey. So if you can imagine a buyer's journey in Salesforce, for instance, the first is come to the realization that they're going to need some customer relationship management software. They do a search online, and the search online, they're going to look for information. So how easy is it for them to get information from you as a supplier versus your competitors? They have to get information on pricing. They have to get information on competitive products. How easy is that? How complete is it? What's the quality of the information? As you move on through the sales process, they're going to be talking to sales reps. How good is the quality of the sales rep? How much can they answer? All sorts of different ways. So if you march yourself down the buyer's journey from the very beginning to the very end, when the buyer's purchased, installed, and is using the product, because that's all part of the buyer's journey, then you can actually develop what the key points on that buyer's journey are. You can go out to potential customers and you can ask them to tell you about each of the points in their buyer's journey. And this is before you've actually created a product. You can then ask them to rate your competition on each element of that buyer's journey. And it does 2 things. Number one, it tells you where the buyer's journey is weak for your competitors, and it tells you where you can add quality by competing against them. So by using this buyer's journey process, you end up with a picture of where the competition is and then what you have to do to actually beat the competition. And if you're doing a good job on that, you can score. You can use market research, or you can use physical tests to score yourself against the competition to come up with an aggregate score on the buyer's journey, and then be able to gauge whether that's enough by doing further market research to be able to get into the marketplace. So that's a complex thing to have to do, but it's possible to actually do it before you write a line of code. And I know this is sort of going against the lean startup methodology. Lean startup says not to do the market research before they say to do a minimum viable product. I fundamentally disagree with that. I think you need to do your market research and figure out, not, you don't use market research to ask what they'd like. You use market research to figure out where the competitors are weak. If you're attacking a market and you said, this is a $20 billion market, and the way Netflix did, and there's a good description of how Netflix looked at it. They said, okay, it's a $20 billion market. Where are the competitors weak? Well, they're weak. They ask for money back. So they ask for fines when you're late at returning movies. So people really dislike that one element. So one of the things they did is they engineered the product so there wouldn't be any fines. So what if you return something late? Well, you don't get your next movie. So they engineered their ability to compete based upon what their research told them about the buyer's journey for ordering movies. So your objective here, in terms of number 2 in the unicorn math, is a high degree of differentiation, measured using a combination of customer metrics, things that are important to the customers. And you're doing this before you've done a line of code. You're figuring out what you're going to develop before you've started the development process, using these metrics to figure out how you'll compete. So for that section, are there any questions?
Looks like no questions, but I'll just go ahead and ask a question. Where do you recommend we go for market research? Is there a source that you like to use or you recommend for founders to go and find information on a market?
Sure, it's a telephone.
Okay.
Go out, talk to the clients, talk to your potential clients. You can go and get market research, and it's valuable. You'll learn secondary market research that's available from Communitech is valuable, but there's nothing that beats talking to potential buyers whatsoever. In fact, I have a few companies I've worked with as an example. One of them talked to 500 potential users before doing their first piece of development. And what they went in with as an idea came out totally different after they talked to 500 people. And it was just asking questions, and you ask questions to 25 people, you gather the information you've got, and then go ask a different set of questions to the next 25, depending on the answers you get from the first 25. People say, won't that slow us down? Won't it take us away from our ability to get to developing product, which will lead to revenue? It'll actually speed you up, because in the end, you'll be faster to develop your minimum viable product once you've actually got that information than you would before. And you'll have a greater chance of it meeting the market needs right out of the box than having to do multiple iterations because you weren't close the first time. Other questions?
Yeah, I think we just got a question here. It's from Glenn. The classic triangle includes cost, quality, and time/speed. It's typically understood that you pick 2. Did you do analysis on what combinations of the 2 dominate?
Well, I tend to say quality and speed dominate, but in actual fact, there's a whole new way of competing that's come into the marketplace. And you can see that from a number of customers. You can see it from Amazon, Uber, and Google, in that they attacked all 3 at once. They brought in a higher quality. Look at Amazon as an example. They brought in higher quality, meaning more titles, more things that you can buy. They brought it in at lower cost. And they did something interesting with speed, is that they differentiated between actual versus elapsed time. The actual time to get an item from Amazon is very short. It takes you, that's why they have a one-click method. It might take you a couple of days to receive it, in which case your elapsed time is larger, but you don't have to go to a store and go back from the store, et cetera, to order something from Amazon. So on that one speed element, they're faster. And secondly, what they're developing is ways to getting it to you faster, even using drones. So eventually Amazon will be faster in elapsed time and actual time. So they're competing on all 3 bases. Same thing with Uber. They're competing on quality, cost, and speed simultaneously. But companies like Salesforce, they actually lowered the quality to compete on speed and cost to begin with, and then brought the quality up. So they attacked a different market segment with a lower quality. So there are all sorts of things that you can do from a strategic perspective in playing with those dimensions, depending upon how you end up segmenting your marketplace.
We have another question from Mike Evans. What about intuition? For example, the iPhone was a hunch by Steve Jobs that the market wanted an iPhone.
Well, I'm not saying that you ask the market what they want. In fact, that's not a very good way to do market research. The better thing is to ask the market what they don't like. And I think you'd get the answers that would lead to the iPhone when you ask the market what they don't like. I don't like the fact that I can't browse the web when I'm out of the house. I don't like the fact that I don't have, well, in fact, BlackBerry was already in the marketplace then, but I don't like the fact that that I can't easily get access to information when I'm out of the house. So, reading and things like that. So just in asking the questions, what don't they like, and understanding that buyer's journey, you're going to get the answers that you want. I don't like the fact that my corporation is dictating what I buy. The consumers eventually made the purchase there.
We have another question. I think it's from Fergus. We also didn't discuss the kind of funding you guys are in the market for. If you have any pitch decks or initial literature to share that I can put in front of my fund managers that I work for.
So I don't understand that as a question.
Yeah, I think he wants, do you have any recommendations for pitch decks or literature that they can reference?
Well, you can see a lot of this stuff on my website, narwhalproject.org, and there'll be more coming as time goes on. But I have nothing that you can put as a pitch deck necessarily.
Okay, so far no other questions.
Okay, let's go on.
Yeah, I think we can move on
to the third item, which is product market fit. So at this stage in your development, you've got a large market, you have something where you're going to be able to compete very effectively. You wanted this third stage is to achieve really tight product market fit, because increasing your product market fit increases your customer lifetime value and makes it easier to raise capital. So when you look at this issue of product market fit, I think you've got to go back to crossing the chasm and understand that, if there are innovators and early adopters, where you actually want to be is in the early majority. You want to be developing products, because the innovators and early adopters will try anything anyway, but you want to be developing something that is in the mainstream of the market, so the early majority. And understand that what you want to understand is that those people are buying for different reasons than the early adopters and innovators. They're buying because they've got a problem to solve. It's usually an operational problem, whereas the early adopters have a strategic problem to solve. So going after that early adopter, early majority, and understanding what triggers them to make their purchase will enable you to figure out how you can get into the market with a greater product market fit than you would otherwise. If you figure out how the early adopters are triggered in a marketplace, then you're not going to be able to successfully attack the early majority and be able to move on to the mainstream market. You'll be restricted in your growth until you actually figure out what's going to cause the early majority to be triggered to make a purchase. Now, I don't believe you can trigger a company. People are triggered by themselves. They have a problem. They don't buy unless they've got a problem and go searching for a solution. You also have to watch into what barriers exist. Have you developed something that's hard to learn? Have you developed something that takes them away from the platform they're normally using, that it's detrimental to the way they do business? So understanding the consumer and what triggers exist and what barriers exist enable you to develop something that's going to have a much greater product market fit. And when you look at that product market fit, I think I love Apple as an example, because the people who love Apple really love Apple. I mean, what other people would line up outside an Apple store to buy a new product for hours in bad weather just because Apple said they should? How many people would go and listen to product release announcements voluntarily from anybody else? But Apple has created this sense where they have a perfect fit for the marketplace. And one of the ways that this is measured is through net promoter scores. And you'll look here, the Apple iPhone sitting at above a 60% net promoter score. And net promoter score is a measurement that you, if you're not aware of, you should look up. It measures the recommenders versus the detractors as a percentage. Apple Cloud, sorry, above 60%. Apple themselves at a 45% level. Even you get down to the older products, the BlackBerry, Adobe, and Oracle, and IBM, and you're seeing net promoter scores below 30. You know, there's some debate, and I have the debate, should you have a net promoter score above 40? That's probably the right idea. Now, when you're looking at a market, you go out and you're probably addressing a large part of the market when you start out. You're not going to get a net promoter score above 40 when you first ask the questions. What you'll get is a mix. And that's when you start to segment your market. And you're not segmenting them because you're not going to serve these other people eventually. The reason you segment a market is to find out where your faster growth is going to be. And your faster growth is where you have the higher net promoter scores, or another measurement that we can get into. So what you want to do is say, let's say you've got 5 different types of clients, measure the net promoter score for each of the type of clients, and spend all your marketing dollars on that segment of the market that has the highest net promoter score, because you're going to increase your rate of growth. It's going to be easier to get into that market. It's going to cost you less. It's going to be faster. And as a result, you're going to have a higher growth rate, which is going to bring you more capital. So the combination of these things starts working together. That's also the place where you have probably the highest degree of differentiation. So when you're looking at it, your big market is your long-term, because after you've got a beachhead in the smaller market, smaller segment of the market, you can go out into the other market. That's not to mean you're not going horizontally. It's you built something horizontally, but you're just attacking markets at different speeds. There's another measurement you can use, which is the very dissatisfied measurement. And that's going out and asking a very simple question of people who are using your product. And the question is, how dissatisfied would you be if this product were no longer available? And when you can get 40% of the people saying that they'd be very dissatisfied, then you've got good product market fit. This is research that you can actually find if you go on the net and just type in something like 40% very dissatisfied threshold or something like that. You can find the basis for this research. So the idea, once again, is you're not going to get your 40% from all the people that you're appealing to initially. You find that segment of the market in which you're getting greater than 40%. That's the place you've got the greatest product market fit, and that's the place you go after in the beginning to accelerate your growth. The third item is another one for measuring after you've been in it a little while, and that's called net dollar retention. And net dollar retention is measured as the dollars of revenue per client in the beginning, less churn plus add-ons, etc. And so what you'll see is the companies with the best net dollar retention, the top quartile, are getting net dollar retention above 100%, meaning they're not churning anybody, or if it is, the amount of add-ons are greater than the amount of churn. Your objective in this should be about 100% in net dollar retention. So the market dynamics for this product market fit are, you want really tight product market fit in the segment that's going to bring you the growth. Targeting a net promoter score of above 30, a very dissatisfied rating of above 40, or 100% net dollar retention. If you're under $1 million at this stage, you want to be growing 20% a month. 20% a month, not 20% a year. If you're over $1 million, you want to be growing at 100 to 200% a year. Those are really minimum growth rates at this stage to be able to get to this longer aim of being a unicorn. And this is where seed capital is used. There's no general starting and stopping line where capital is applied and where it isn't applied, but generally around this phase, you're using seed capital to prove product market fit. Which leads to the end of the third section and questions.
So far, no questions for this section. We'll give it another few seconds here in case people are typing. We have a question from Katie. What is seed capital?
Seed capital is Typically, if you're looking at the types of capital that you get, and the names are a little funny because it used to mean something more than it means nowadays. You get money from the founders and friends and family as the first type of capital you get. The second type you get in small amounts of about 100,000, let's say, from companies like Y Combinator, which is an accelerator. Communitech used to have an accelerator program. I'm not sure if there was capital applied to it, but people like Techstars and things like that have capital for companies in their accelerator. The third type of capital is seed capital. On average in the US, that might be around $3 million worth of capital to seed you through the development of the idea, to seed you through understanding product market fit primarily.
All right, we got a bunch of questions. So next question. How do you recommend companies measure NPS, in the product or surveys?
That's a good question. If you have a product that you can actually do a simple question at the end of a user session, it's really powerful. You don't apply it to all of your customers. You might do it like 1% of the time that people come in, so they're not pestered all the time with something like that. But it's a lot easier if you can do it and build it into your product than if you go out to people afterwards, because they're in the flow when they're in the product and they're more likely to answer the question at that time.
Our next question, what about your own consumer usage metrics like Slack's 2,000 messages per month? Or keep it simple with the standard ones that can be compared to others?
Each application is going to have its own metrics, and we're not getting into all of those metrics now. In fact, there are, a good company will be following 50, 100, 150 different metrics. In fact, each person or each executive should be responsible for a suite of metrics and a key metric. So the Slack 2000, was that 2,000 messages? That's a particular one that works for them. You're going to have to develop one that works for you, depending upon the nature of your application, the nature of your user, the interaction between your user and your application. But they are particular measures of, you can measure users, uses, and usage. And some of them, like Slack's, is a usage measure, but you also want to measure users and uses.
We have another question. We actually get this question a lot of Communitech. As validation stage companies seek to reach excellent product market fit, is that when they should start to think about defensible intellectual property, things like trademarks, copyrights, and patents?
No, I think you should start thinking about that right in the very beginning. If you've got something there, you should be able to figure out your competitive differentiation before you start. And so before you actually get out into the marketplace, you've got to be thinking about that type of defense, or you want to call it a defensive strategy, you can do that as well. But the earlier that you think about that, the better.
I think we'll end it off at for questions for this section.
Okay. So item 4 is marketing efficiency. And right now, you've actually gone through these in order. You've found your big market. You don't start until you find a big market. You've established your basis of competitive differentiation. You found good product market fit in a market. Now you want to make your marketing efficient, because the greater your marketing efficiency, the easier it is to attract capital, and good marketing efficiency lowers your capital requirements. So it all goes hand in hand. So you don't want to start trying to figure out marketing efficiency until you've got product market fit. It's not worth doing it. And you don't want to scale until you figured out marketing efficiency. So there are a number of different ways of measuring marketing efficiency. And what I wanted to emphasize here is something that is that people don't realize is how much marketing and sales is in the development of a company and how important it is. These are the average numbers for companies that went public when they were going public. Marketing and sales as a percent of revenue is over 60% in companies that $10 to $50 million. It's over 50% at $50 to $250 million. And it's just under 40% for firms that are more than $250 million in size. Marketing and sales is the number one expenditure in a company. It's the marketing and sales expenditure that's going to make you grow. No amount of R&D expenditure will make you grow. marketing and sales is the most important item that relates to growth. And there are a number of different ways of looking at it and measuring it. And so what I want to do is compare, and this is for software companies, but I'll give you something on medical device in a second. Marketing and sales as a percent of R&D at IPO is 2 to 2.5 times R&D. And in successful companies, they are spending as much on marketing and sales from the minute they start their business as they're spending on R&D. So even as they aren't in the marketplace, they're spending on marketing and sales to understand the market and understand the relationship of the product to the market that they're going to bring out, and spending as much on marketing and sales from day one. It's a classic Canadian problem of delaying expenditure on marketing and sales, delaying hiring the marketing and sales people until you finish the product, and that puts you behind the curve. American companies start right at inception to spend on marketing and sales, and by the time they're a couple of million, they're spending twice as much on marketing and sales as R&D. Now, medical device companies, 5 times as much on marketing and sales as they spend on R&D. The R&D is done early. Later on, marketing and sales is the predominant number. So it's marketing and sales that's going to fuel your growth. And that's why it's important that your marketing and sales, your marketing efforts be efficient. And there's a funny calculation that I did in looking at these companies that went public, is that I looked at marketing and sales as a percent of next year's revenue, because everybody's dealing with spend money in one period and you're going to get revenue in the next period. Effectively, there's whatever that period is, could be 6 months, could be a year, could be a year and a half, whatever it is. It's important to measure how much marketing and sales, how much growth you get, how much revenue you get out of that. And when you look at the numbers, it's really astounding, because the really good companies like Shopify and Dropbox have a very low percentage of marketing and sales as a percent of next year's revenue, 22, 23%. You look at their capital as a percent of revenue numbers, and they're sitting at about 1 to 1. They need a lot less capital because they're so efficient at marketing and sales. It's one of the reasons Shopify has been so successful in the market, is they're able to grow really efficiently. Cloudera is coming in around 62%, Box at 80%. Look what happens to the capital requirements when your marketing and sales as a percent of next year's revenue isn't good. Your capital is 3 times the amount of revenue you get. So real efficiency here is critical. The average is about 37%. So let's call it a third. So if you spend $1 this year, you're going to get $3 worth of revenue next year. And at that level, your capital is about twice your level of revenue. There are a couple of other metrics you can use in evaluating marketing and sales. And in fact, you can start to look at all sorts of metrics all the way down in this. And there are all sorts of efficiency metrics you can use. But 3 of them are LTV over CAC, which is lifetime value, which is, so you get a customer 1 year, what are they worth? If they're average, they're going to stick around for 5 years. What are they worth in that 5 years is your lifetime value. And CAC is your cost of acquisition. How much does it cost you to acquire the customer? Well, that's a ratio of 3 to 1. Similar to the previous ratio we saw, is if you can spend $1 to acquire the customer and they're worth $3 in the long run, and you can get better than that, that's good. You're getting less than that, you've got a problem in marketing efficiency. CAC payback, meaning how long does it take to pay back your cost of customer acquisition? You want about a 12-month payback on average. Net logo retention, meaning what percent, similar to net dollar retention, you want over 100% net logo retention. So these 3 things are things you're going to look at. And once again, you've taken your product and you've segmented the market based on product market fit. You can then do the same thing with marketing efficiency, is segment that market even further down to that portion of the market in which you can be really efficient. And so if you've taken 5 different segments of the market and you're dealing with 1 or 2, now take those 1 or 2 and say, where do we get the most marketing efficiency? And you put all your dollars in there to attract that customer, because that's going to get you the highest growth at the least cost. So this marketing segmentation is critical because it can boost your growth rate at a much lower cost overall. So here we go. The 4th of the elements is marketing efficiency dynamics. You're wanting high LTV or CAC, high cost of acquisition payback, high net logo retention. Target metrics, marketing and sales as a percent of next year's revenue, less than 33%. And this is where you're going to have to grow. If you're between 1 and 5 million, you're growing at 100 to 200% a year. And you're going to want to, if you're above 5 million, you're growing at 60 to 100% a year. Really critical that you get growth rates. I've met a lot of companies that are growing at 30 to 40% a year. They have trouble attracting capital because it isn't part of a formula that works for venture capitalists. You've got to keep those growth rates above that 60% number to keep attracting capital all the way until the point in time you go public. The financing that's used typically to figure out the marketing efficiency is your Series A financing. So in that, maybe in Canada, it might be more 6 million, in the US more like $10 million to figure out marketing efficiency and to do all of the experiments necessary to figure out what's most efficient as a method and which segment you can be most efficient in. Because if you've got the large market, you've got lots of room to grow in that segment to start with, to fuel that growth rate above 60%. Questions?
We'll wait a couple seconds here in case people are typing. Okay, I think we can move on to the next section.
No questions?
Doesn't look like it.
Oh, there's all sorts of things.
Oh no, we got last second question here. Is an integration channel strategy an effective approach for market efficiency?
Well, define what you mean by an integration channel strategy. Might take a second to get that answer back, but
yeah. Is an integration API to Salesforce?
Are you talking techniques? So you're talking. Well, the more integrated you are, the easier job you're going to have is to measure these, to measure your results. The more integrated you are, but you can still do it on a piece of paper. It's not. It isn't the most critical thing. The critical thing is that you have these measurements and that you're evaluating them on an ongoing basis.
Looks like he's talking about partnering and to integrate with existing players.
Oh, that depends upon. Okay, sorry. So integrating with, so in your case, it wasn't a technical integration. It was integrating with Salesforce to get your product out there. Depends on what you're selling. I grew Synamics with partnerships with Lucent and Nortel. But what it means is that you're subject to their strategic whims. In the long run, if you want to create a fully independent company that is unicorn worthy, you have to be doing it eventually on your own. You can't rely on somebody's downstream strategy. And in fact, there are all sorts of examples of companies, Hootsuite, that relied on a downstream strategy to get out to the market and were whipsawed by changes in demands. I mean, if you got a strategy on YouTube to develop something and YouTube changes their parameters for search, you've got a big problem. All of those things, you can't be subject to somebody else's strategy.
We do have another question. What are some examples of marketing and sales costs at inception or pre-development?
Most of them, in fact, I'm working with one company now, and they've just hired somebody in to manage the product market fit measurement. And in fact, you actually say to someone, okay, your job is to manage this product market fit measurement. So the person is going out there and recruiting people to get back information on product market fit, to evaluate design changes, to evaluate components of the product, et cetera. And so that's a market research function predominantly. You also have a product marketing function, and that is the taking the understanding of those user requirements and translating them to engineering. Quite often that product marketing person sits in engineering, and it shouldn't. It's really a marketing expense, and it sits between the customer and the engineering team. When there's a natural degree of tension between what engineering can produce and what the customer wants. And so the product marketing person sits between them and mediates that and tries to find a way to meet the customer's needs through things that can be engineered effectively. So those are two: marketing research and product marketing are things that you need right from inception.
Looks like that's it for this section.
Okay, last section. Capital sufficiency. The more capital you have, the higher the growth rate. The higher the growth rate, the more capital is available. It's really astounding. And I found this most when I did a study of all the firms founded in 2008. And I went in and I looked at firms and I said, okay, the ones that raised the most dollars initially in their first round of funding were the ones that in the long run raised more overall. The more you raise early on, the more you raise in the long run. So they don't start out small, they start out big. And the reason for that is simple. If you go out into the market and you raise, let's say, $3 million in your seed round, you can get to point X. If you raise $6 million, you're going to get a lot farther. You're raising money in the same period of time, every 18 to 24 months. If you've gotten twice as far, you're going to be much more attractive to the next funder. You want to be attractive to the next funder, so you want to raise as much capital as you can, as soon as you can, to fuel that growth rate. You cannot look at capital as something that you should be cautious. If you're in this game of creating a unicorn, it's applying as much capital as soon as you can to fuel your growth. And that's why this relationship of the more capital, the higher the growth, and the higher the growth, the more capital is available, is really critical. And it's what stalls a lot of companies is they don't get enough capital, they grow at 20 to 30%, then there isn't any more capital for them to grow with because nobody wants a company growing 20 to 30% a year. What are you going to spend the money on? And this is another really important, critical issue. 95% of the companies that went public in the last 8 years were losing money. Shopify was losing money. Everybody loses money to fuel growth. And in fact, if you look at losses as a percent of revenue, for companies under 50 million, they're greater than 60%. For companies 50 to 250 million, they're almost 40%. Even companies $250 million in revenue are losing 20% of revenue. On bottom line losses, there seems to be an idea, and I met an entrepreneur recently who thought, they're going to be profitable in 14 months. And I said, well, you're going to destroy your growth rate then, because it's losses that fuel growth. You really want to lose a lot of money, and it's worthwhile because the market values growth so highly that it doesn't matter what you lose in order to get there. This leads to the second item, which is capital as a percent of revenue. And this company that I was talking to expected to get to $770 million worth of revenue in 5 years with $25 million worth of capital, which is better than any firm that has ever been created in the world has been able to achieve. So capital as a percent of revenue is a key number. You need massive amounts of capital to fuel the losses, to spend on marketing and sales, to drive the growth that's going to get you more capital. So capital as a percent of revenue is typically about 2 to 1. In fact, if you look at, I don't have the slide in front of me, I usually use this slide. If you look at Facebook, which is one of the biggest unicorns ever, a super unicorn, they used $340 million worth of capital to get to $153 million worth of revenue. So over 2 to 1, exactly on these numbers. You'll see very successful companies typically using about 2 to 1. You go back to the marketing efficiency. If you're really efficient in marketing, you can do a 1-to-1 ratio of capital to revenue. But you cannot have average marketing efficiency and low capital to revenue ratio. It just doesn't work. There aren't examples of successful companies doing that. So understanding how efficient you are in marketing is a real understanding of how efficient you are at capital utilization. And target, when you're starting, to use $2 of capital to get $1 of revenue. Uber versus Lyft is a great example. This is the graph of the two companies and starting out and the amount of financing they received. Uber in 2019 had received over $30 billion worth of capital. If you remember from a prior slide, they were about 14 billion in revenue. There's that number again, that 2 to 1. Lyft, which had not received that level of capital, did not have that level of revenue. Simple as that. Same market, two different companies. You can compare their capital, their revenue, and their valuation. Interestingly, what you've got here is, as a ratio, Uber has the much better valuation because they have the much better growth rate. So it's fundamental to success to be fueling your growth with massive amounts of capital if you want to become a unicorn. So the final capital sufficiency dynamics is your objective is enough capital to support continued growth. Industry dependent, of course. You look at the medical device industry, it's a lot more than 2 to 1. It's more like 5 to 1 in terms of capital, ratio of capital to revenue. Growth, you want to be doing 60 to 100% a year. And if you're growing public at around 250 million, you still want to be growing at 60% a year when you're going public in order to be able to get the valuations that are going to earn money for your investors. And here you're looking at a Series B financing, Series C, Series D, et cetera, that are going to fuel that growth in ever increasing amounts as you succeed out into the marketplace. So questions in this final section, and we'll sum it up.
Okay, we have a couple questions on this one. Is the growth fuel at the expense of trying to retain 50% plus ownership?
If you want to become a unicorn or go public, you will never, I can't say never because maybe there is somebody, but it's very, don't try and maintain 50%. It doesn't work.
We have another question. One thing that all unicorns have in common is their visionary storytelling, which allows them to attract capital at a much lower cost. Shopify, Amazon, Peloton, and Tesla come to mind. Wondering if you could share your thoughts on the link between storytelling, capital sufficiency, and cost of capital.
Well, storytelling is an important ingredient. You have to be able to, get an emotional reaction from a potential investor. But fundamentally, the emotional reaction doesn't work if you've got bad math. If your algorithm for growth doesn't work, no amount of great storytelling ever works. Well, except maybe Theranos. It certainly worked for Theranos, didn't it? So maybe that's a bad example. Ultimately, let's say not in the beginning, you have to have an algorithm for growth that works along with your story. If you have a lousy story, you're going to have problems, but eventually somebody will see the numbers and be entranced by the numbers, no matter what the story is.
That question about 50% plus ownership, it was referencing Facebook, I believe. It was asking about Facebook.
I don't know off the top of my head. Mark Zuckerberg does not have more than 50% of Facebook, does he? I'm pretty sure.
I don't think so, but I'm not sure.
Somebody might want to Google that and actually type it in the chat if you can figure out what percent of Facebook. But no, when you look at it, the formula is that your valuation as a company, and I've got another report that I've never issued on that, is equal to 4.7 times total invested capital. So if you've had 10 million of capital invested, you're worth about 47 million. And if you add another 10 million of capital to that, whereby you're then have had 20 million of capital, you're worth about $94 million. It's a really straight line, and it's really interesting to see the degree of correlation between the amount of capital you've got in your valuation. You can look at all the unicorns. You can do math yourself because you can go on Crunchbase, find out how much they've raised, and figure out their valuation and see that ratio of about 4.7 times. What that means is that you give away about 20 to 30% of your company every time you raise capital. Now, that's why you want to raise more capital than less, because you raise 10 million, you're going to give away 20 to 30% of your company. You raise 3, you're going to give away 20 to 30% of your company. So it's an odd in the way that works. So you want to be raising more. And because your valuation is not absolute, it is relative. And it's relative to what you're going to create. And the more capital you have, the more you're going to be able to create value. So the more you're worth. So with those things in mind, if you look out 3 rounds of fundraising, you're not at, you're less than 50% by the time you've hit 3 rounds of fundraising.
We have a couple more questions here. If you're waiting to raise capital based on having product market fit first, doesn't that go against raising more capital earlier? The company that raises more at the same stage without product market fit and less efficiency would still have an advantage.
Yeah, they would. They would, absolutely. The more you raise, the earlier you raise it, the more of an advantage you have. Now, that depends on your investors. Typically, American investors in A rounds invest more than twice as much in companies than Canadian investors. They put more in. They also put it in earlier, and you can measure that by looking at the number of employees that are in a company when the investors invest versus in Canada versus the US. So the Americans invest more earlier, which causes faster growth.
Doesn't look like there's any other questions for this section. Plus, we also have 7 minutes left.
Yeah, let me just summarize then.
Sure.
So this is going back to what I was talking about at the very beginning. You need about a $20 billion market, a 50% customer differential, an NPS of greater than 30 in the segment that you're going to attack first in a horizontal market, with marketing efficiency of marketing sales less than 30% of next year's revenue, to generate about 75% growth a year. And if you're doing that, that growth is going to attract capital, and you're going to need about $2 capital for $1 of revenue. And finally, on the right-hand side is you can get a unicorn valuation equal to about 4.7 times capital when you're about $125 million worth of revenue. And this is the result of looking at thousands of companies over many years and figuring little piece by little piece out. I don't have all the answers here. I'm really excited by the next thing I'm going to discover, and I don't know what that is, because every now and then I do a piece of research and some new thing crops up. So a year from now, there might be a whole different set of variables here, but these are fundamental to what I've seen in success so far. And even if I add new ones, there might be nuances to these, but I haven't seen anything in particular that would lead me away from these. If you want to do this yourself, and every industry is different, the number that I've used are, I've mentioned software numbers, I've mentioned medical device numbers. You want to look for industry research. Go and get the prospectuses of all of the competitors that are in your niche. All the companies that have gone public over the last little while, all the ones that are public, look at their annual reports. Figure out what they think about their market opportunity, their basis of differentiation. They often have measures like Net Promoter Score in there, and you can find those things on the web. Understand their marketing efficiency and their capitalization. When you're building your forecast or an economic model for yourself, you want to really be building all of these things into your economic model. It's an area that isn't discussed very often, the economics of growth. And I'm trying to promote it because I think a lack of understanding of the economics of growth is making people make decisions that are suboptimal. Not understanding that you need to grow at 60 to 100% a year. I talk to people who are trying to grow at 30 to 40% a year. And my question is, why aren't you trying to grow more? And they don't really know that they should be trying to grow more. But it is essential that you grow more if you're going to be successful. And these are the elements that I think are built there for success. Now, we've got 5 sessions of a program coming up. Each one of those sessions drills down into each one of these 5 variables. So we'll look at such things in more detail, like valuation. We'll look at more things that relate to product market fit, that relate to measuring differentiation, etc. They're about 1.5 hour sessions. They're interactive, so we stop and I get you to do things and ask questions and things like that. So if you're interested, you can sign up. Gamal will give you instructions on how to do that. And then in the last 5 minutes, and if people want to stay and ask questions, I can stay and answer questions for a while, and Gamal can stay and interpret that. So Gamal, I'll hand it over to you.
Amazing. Thank you very much, Charles. Yeah, so just to reiterate, I've just put in the chat the dates of these sessions so you guys have them ahead of time. In between those sessions, when you attend the session, after you attend the session, you will be able to meet with Charles if you'd like to meet with him to chat one-on-one about something specific to your business. To attend the session, it's really easy. Just send me an email. Just send me an email on which sessions you would like to attend, and I will send you. I will invite you to those sessions via Google Calendar as an invite. Just before we end off over here, we do have one more questions, but I was just going to open up the last couple minutes for questions before we end off here. We have a question. What kind of talent should we be looking for that could help us put together the phases that we discussed? What skill sets in particular to look for?
So that's a good question, because I think of these in terms of intellectual property that you need to acquire as a firm. So you have to have three basic types of understandings to be able to grow. Number one is technical IP. Number two is market IP. So technical is understanding of the product and how to build it, how to protect it, etc. Market is understanding what the market is, where it is, what its needs are, how to get to it. And the third is process IP, which is how to take an idea and get it into the market. And in that, you're looking at, in particular, the go-to-market strategy as part of the marketing process, scaling strategy as part of technical scaling, and financing strategy. So all of those are elements, and there'll be a paper coming out, at least in the beginning of January, which is targeted towards more towards governments, but takes this perspective of what things do you have to know to be able to be successful as a company.
We have another question here. What were some of the last Canadian unicorns? Also, what are some things you can do when you have no competitors and your substitutes have so little in common with your product?
Well, two questions. First, before that, if anybody has other questions, they can always reach out to me and connect me on LinkedIn, and I'm happy to talk with you. I'm happy to meet anybody actually who wants to meet and ask questions in depth at any time. So just get in touch with me whenever you want. So examples of Canadian unicorns. Well, there was Kik was a Canadian unicorn that existed in Waterloo for a long time. In fact, it was our only unicorn for a long period of time. Right now, Coveo is a unicorn, and Nuvei went public. They were a unicorn, and there is one more, and it's escaping my mind. I've just forgotten because I'm terrible with names. Sorry?
Applyboard?
Applyboard. Of course, how could I forget Applyboard? They're a Communitech stalwart.
Yeah.
In fact, I even predicted that they'd be one. So I was proud of that. And you can go look at the numbers, look at their employee numbers and their employee growth rates, and look at their financing numbers as good examples. Canada, unfortunately, is last in the world at the production of unicorns based on the amount of capital used. And that's something we're trying to change.
So that brings us right on time for 3:30. So I think there's a couple more questions that are coming up, but we can send those over to you, or they can be sent to you directly on LinkedIn. Thank you, everyone, for joining our Ask Me Anything session today. It was a pleasure to have you, Charles. Thank you very much for taking the time, and thank you for helping us with developing the future sessions. Hopefully, if you guys got a lot of value out of this session, and you guys think about attending future sessions, I'm just going to repeat it one more time. If you guys would like to attend the sessions, simply just send me an email on which sessions you would like to attend, and we'll get you signed up. And I think with that, I wish everyone a great afternoon, and I hope to see some of you guys at the sessions.
Thanks a lot, everyone.